Hello, welcome everybody to the monthly roundtable. It is the August edition. I'm Urmi Desai, editor here at Move Smartly. I'm joined by my colleague, John Pasalis of Realosophy Realty. John is back in Toronto. Hi, John.
Oh, yes, back in TO.
After a month in Greece.
I mean, traveling's great, but I have to be honest, I love the city. I love Toronto, so it is kind of fun to be back.
Yeah, in summer it's nice here. And Steve, you are out in Vancouver with Oakwin Realty. How are you doing out there?
I never leave. Yeah, no, things are good. It's nice and hot in Vancouver, so summer's in full swing, market's slow. So yeah, I mean, there's lots to talk about still, but
Yes, actually there is. But first, Steve, do you want to expand a bit on that, on the numbers in Vancouver right now and what the
yeah.
feeling is on the ground, whether that's still translating into the same kind of trends we've been seeing?
Yeah, I feel like there's nothing like in the numbers that really like stands out. We're like, oh, this is a 20-year low in this or a 10-year high in that. Like there's nothing like if you look at the numbers, like sales volumes are definitely below like long-term averages, but like it wasn't like a complete horrendous July. New listings are definitely running high. I think outside of 2020, they were some of the highest, the highest we've seen other than July of 2008. So we all kind of know what was happening then. So I think what we're just seeing right now though is there's a lot of product just stagnating, particularly in the condo market. I think it's really, really important again I know we've emphasized this over the last 6 to 12 months on this call, but like it's a very segmented market today. Entry-level detached houses, we all know we're not building any more of them. It's particularly in Vancouver. Those are definitely in still short supply. They're still moving. Maybe just instead of getting 4 offers, they take 2 weeks to sell and you only get 1 offer. But that's much different than what's happening in the condo market, where I still think investors are non-existent and a lot of them are opting to put units onto the market and trying to get out. And so that's just putting added supply onto the condo market.
So supply's up, Steve. Are you seeing prices hold? And let's talk about the freehold and the condo sector separately, because it seems like they are going in separate ways.
Yeah, prices are coming off. Detached, I would say modestly, right? Because like again, instead of like in the spring market, early spring, we were getting, a lot of these entry level houses were getting a couple of offers on them. And so when you get a couple of offers on a house, like, people tend to either bid at asking price or even slightly over list. And so that kind of kept the prices pretty firm. I think what we're seeing now is that, again, these entry level houses will take 2, maybe 3 weeks to sell, and they'll come in like slightly below list. So, like, I guess in that context, they're coming off a little bit. Condo market feels like there's some segments of it where it feels like it's gone almost no bid, which is like you drop the price, you still don't get any offers, you drop the price again and okay, maybe you get an offer and it's coming in a little bit lighter. And so I think the condo market for sure, I think there's also a lot of sellers that are sticking their heels in the ground and hoping and waiting for better days ahead. So it's really just if you can find a seller that actually needs and wants to move, like if they need liquidity, i.e. like, hey, I got to get out of this place, like I'm closing on another property and I need out, like you're gonna have to take a lower price.
And what's the mood then amongst your clients, buyers, sellers? Are there different moods if you're trying to sell or buy a condo versus a house?
Yeah, well, it's tough, right? Because like John, I'm curious if this is what you're experiencing, but like, okay, so like it's pretty common where you see like a condo owner will want to upsize to, let's say, a detached house. So like the detached market's not really in a market where you can make an offer subject to sale. And so you're now in a situation where like, well, I want to upsize, but like my condo is really uncertain. I don't know how long it's going to take to sell. And I really don't really want to upsize. I don't want to like commit to purchasing something. So like adding in a subject to sale clause is still really hard for sellers. They don't need to accept those clauses in the detached market. So we're seeing some buyers say, okay, well, I'll do a 3.5 or 4 month close on the house. I'll commit to purchasing it today, and then I'm going to turn around right away and list my condo and get fairly aggressive on the price so I can move this thing and have the dates kind of work. So but that's risk. There's definitely some risk there, and it's not something we tend to encourage people to do. But at the same time, if people want to upsize, like sometimes that's what you got to do.
Interesting. And John, over to you in Toronto, same thing. What are the numbers saying? And then what's the mood like?
Yeah, I mean, numbers very similar to what Steve kind of unpacked. Not a lot of changes, since last month. Sales are still quite soft, even for this month. I mean, we're pretty soft sales volumes. And again, listings volumes are pretty typical for low-rise houses. They're very high for condominiums. So we do still have this slight difference between low-rise and condos. And just like Steve described, the one shift I'd say over the past 6 months for low rise is there's definitely fewer bidding wars, a bit less competition, homes sitting on the market a little bit longer. And yeah, of course, we've been seeing that for condos, but it's obviously a bigger shift kind of, I'd say, in the low rise market because it's typically a little bit more competitive. But even in the low rise market, things are sitting. And we have clients in the exact same position that Steve discussed, and not just clients who want to upsize from a condo, clients who want to upsize from a house to a slightly bigger one. And they're in the same predicament. They're kind of very anxious to buy, without having sold their home and then just listing it after, even with a 3-month closing, because they're just looking at other homes in their neighborhood sitting on the market for 2.5 or 3 months, right? And again, it depends on the home in the neighborhood. A lot of homes are selling quickly, but some homes in some areas are sitting in the market longer. And again, this is typically sellers who are a bit aggressive on pricing, but if you need to list in that area, you're going to be anxious. So, there are definitely some people who are a little bit stuck and would like to upsize, but they can't, again, because they're worried about selling their home.
John, I think that's a really crucial thing I just want to emphasize, because that's just what we've been dealing with here on our side just over the last month or two. It's just, we had one client where they had an accepted offer subject to sale. They were upsizing and just trying to turn around and move their condo in a timely fashion. Couldn't get it done. We've had people where they committed to purchasing and then they had to quickly turn around and sell their place, and they were just under that time crunch. So then they're having to reduce probably more than they want to. We've had, just a lot of these stories, and some of them are anecdotal with other clients in the office here, or other agents in the office. And it's just a lot of people that are trying to make moves. And it's just really difficult because there's so much uncertainty about, like, how long is it going to take to sell your existing place, and what is the price you're going to get for it. And those are two really, really difficult things to answer right now.
Yeah, and Steve's 100% correct, because people come to us and be like, okay, I want to bid on this place, I want to buy. What am I going to get for my home, right? And like normally, or a condo, and normally that's a pretty easy question to answer, right? But when things aren't moving, it's such a hard question to answer, because like in theory, if their home's worth 1.5, like, yeah, maybe they'll get it and get 1.5, but it might take them 4 months or 3 months, and they don't have that much time, right? And Steve's right. Once you've bought and you need to sell, you kind of become a distressed seller, right? Because if your property's not moving in the first 30 days and you only have another 30 to sell it, and you have to sell it, you're slashing the price more than you want to and more than you in theory should, because you just need to get it sold. And I think that's the tough part to navigate now. Like when we have clients who need to buy and sell, we're kind of reluctant. We don't really advise them now, for the most part, to buy first because of these risks, right? Because
yeah, and I'd say, like, for example, you have, like, let's just say, client comes to us and will say, listen, I think based on kind of where the market's at today, we run our numbers, we know this market really, really well. I think you should land between 950 to 975. That's kind of your market value. But don't be surprised if you list it and you start getting bids at 900.
yeah,
and that might be the best bid you get, because, like, yeah, I think you're worth 950 to 975, but the market's incredibly uncertain. And so, like, obviously, again, think about someone that's upsizing and say, well, if all of a sudden they're leaving 50K on the table, that's not insignificant, and obviously that those numbers can be larger. It's just really hard to give people valuations today because of, I would say, a relatively illiquid market in some segments.
So in these, let's say, mixed conditions, the comms person and me noticed an interesting messaging exercise battle kind of breaking out in the Toronto Star. The headline is Toronto area home prices drop in July as real estate listings pile up. And the subheader there is, while prices dropped, real estate unit sales edged upwards, indicating the positive impact of the Bank of Canada's interest rate cuts, according to the Toronto Regional Real Estate Board, or TREB. So on the one hand, there's a suggestion that some sales are picking up because you two both have been talking about resetting seller expectations. Maybe some prices are finally coming down. On the other hand, TREB wants to mention that it's those interest rate cuts making the difference. What's your take on this?
I mean, I think TREB's always looking for the, the good news story and bad data. I mean, sales, I mean, what are they up in their data? Like 2%, like it's modest. It's not, there's no bullish narrative. Like even if you look at the sales volumes for July, I mean, it's close to a 20-year low. I mean, it's similar to last year because that was pretty much a 20-year low, but it's probably like 35 to 40% below kind of the long-term average. So there's no real bullish story here. I don't think what's going on, like rates yet, are having a very big impact. They might in the months ahead. Again, we're seeing way more movement recently, in bond yields and stuff like that. And that translates into much lower rates in the fall. Yeah, maybe, but I don't think it's the two Bank of Canada.
I think we should unpack that a little bit further though, too, right? Because like you've got a couple rate cuts, you're gonna get more of them. I think that's pretty obvious at this point. But like it hasn't really changed like the math that much, right? I mean, like people that are coming up for like your fixed rates today, John, like I'm sure they're gonna move here with bond yields in the next 7 to 10 days. So like let's just say, the new rate moving forward here in the next week or so is gonna be, call it 4.5. That's probably where we'll probably land in the near term. So like, people that are going to be renewing over the next 4, 6, 8 weeks, or we're going to be renewing it instead of, they're going to be renewing their mortgage off of 2.5, they're going to be still going to 4.5. So I guess that's less bad than when it was at 5.5, but like either way, people are going to be seeing a jump in their payments. I look at all these like investors that are caught offside and negative cash flowing condos. And, I don't think the math is going to be that much different. It's going to be less worse.
Yeah.
But it still doesn't make sense. And I think same thing for a lot of these developers that are caught offside with unsold inventory or, or trying to get off the ground for a new housing start and pre-selling. I just don't think a 50 to 75 basis point change in rates is going to be a real difference maker.
Yeah, I mean, I agree. Like, I think it might move some end users off of the sidelines. You know what I mean? If their rates in the mid-4s rather than the mid-5s, but I don't think it's going to lead to a booming market by any stretch.
And just following up on the other side of that, is it then the price drops as sellers move expectations? Let's talk specifically about the condo market. Steve retweeted your chart, John, showing Toronto condo listings hitting a huge high of 7 months of inventory. So the condo listings are piling up. Would that finally result in those resetting price expectations, leading to more sales? Or as Steve is suggesting, like some people are dropping their prices and people are still not visiting these condos. So what's going on? Is it just this segment, because the investors are not there, is undergoing a completely different dynamic?
Well, yes. And just to clarify, I mean, when I tweeted that chart, the 7 months of inventory, I mean, approaching was for the city of Toronto. The GTA, I think, was closer to 6. And what's happening are two things. I mean, number one, end users are not very active. We see this in the low-rise market and the condo market. That part of that's because prices are so high. Investors aren't buying units. And on top of that, they're very eager to sell units, right? And they're rushing to sell for two reasons. Like Steve said, the math doesn't work. Anyone renewing who bought recently has got to renew at 4.5%, 5%. The math doesn't work. I think CIBC and Urbanation published a report. I think they were kind of looking at how many of the units or the percentages that were cash flow negative of recent completions. I think Steve tweeted it's something like 80+%.
Yes.
You know, and listen, investors are fine. We're fine with cash flow negative units. The difference now is that the amount they're negative is a lot higher. And number two, condo prices aren't increasing, right? And this is, you know, one of the conditions has been of Toronto's condo market, and in particular the pre-construction market, is that prices have to keep rising. It all falls apart when prices are flat, right? And I think this is why it's been a problematic housing market, because as we're seeing now, the second prices stall, no one wants to buy anymore. At least investors don't want to buy anymore, because they were only buying on the capital appreciation. They didn't really want to keep it as a rental property because the rental math just doesn't make sense.
And Steve, I don't know if you have anything to add to that. I want to come back to a question on prices after that.
Yeah, I mean, I just think that it's a really tough sell today. And now we've talked about this, and John, I think we talked about this when rates were at zero. Like when rates are zero and there's not a lot of alternative, of course, people start piling money into becoming condo investors, right? I mean, better to park your money in a condo than it is to sit at the bank and earn 0%. I mean, today, you can put it into a GIC and earn 4.5%. Or you can buy a negative cash flowing condo and lose $1,000 a month. Like it's just a different equation today. And so I think that's just the reality of how much rates have changed over the last 24 months. And so, yeah, they're coming down now, but I mean, again, 50 to 75, even 100 basis points really doesn't really change that equation that much. And so I think that, it's just a tough sell. And I mean, I can say here in BC, the politics are shifting more and more towards the tenant and less to, like, it's becoming much more anti-landlord. That's just where the politics are. And so I just don't see a very compelling investment thesis to be a landlord in BC today at today's interest rates and today's numbers and today's politics. So I think it's a multitude of all of those together. I think that's why we're just seeing, like, there's no investor bid. And so you have to look at the markets that are most impacted by the investor bid disappearing. And I think that's, in my opinion, that's in downtown Vancouver, where I believe it's close to 60% of the market is renters in downtown Vancouver, right? It's very transient. People come there and you rent, you to be close to work and everything. So 60% of basically those buyers are almost investors, and they're gone. And so that's why that market's so soft.
All right. Well, I seem to always return to this question of prices because this corner, this new segment that we keep coming back to, in my mind, is actually called Urmi Needs a Condo Deal corner. So you've been talking about prices being flat. Now, how long can that be? We've talked about exposure of investors, 80%, I think Urbanation report, you're right, John, showing that these units are losing money. But I wonder, are these investors just very deep pocketed? And they can hang on, and prices will not necessarily come down. They'll just continue to manage somehow.
I think that's a great question. I think it's tough to predict. I think we've talked about on this show that, I mean, typically prices are sticky on the way down, which basically means, prices are not sticky on the way up. I mean, they can skyrocket 20% in 2 or 3 months, right? They're typically sticky on the way down, which means that sellers are stubborn. They'll hold out as long as they can for the highest price possible before they gradually start reducing. So it usually takes time to see prices decline. The past couple of declines we had in the Toronto area were a bit different because the sellers were distressed. They bought and sold 2 properties. So it's a bit different. Now these investors are not caught in 2 transactions. They're just probably over leveraged and want to sell. So some probably are well capitalized, some who have bought 10 years ago, don't have a big mortgage, maybe are, and they just want to take some money off the table. Some maybe are overstretched and need to sell. It's hard to say. you know, at some point, if inventory continues to build, I mean, the most likely outcome is you're going to have some sellers just throwing in the towel saying, I want to move on. And even if they're not distressed, they're kind of just tired of it. You know what I mean? They'll, rather than taking $100,000 gain, they'll take like a $70,000 gain. You know, and most of these investors have a capital gain. Only the ones who bought very recently or closed very recently probably don't. So it's a waiting game to see how this all plays out, quite frankly.
So explain that to the common consumer, John. They're losing monthly cash on their units, but they're still banking on not wanting to cash out on a lower capital gain than they were expecting. Are these people doing the math like that perfectly? Like, at this point, I am now losing more than I would ever have made, or is it still emotion involved?
Well, I mean, it's emotion. Like that's what it's like, it's behavioral. That's why people are stubborn and don't want to sell. Listen, people have seen slowdowns in the condo market multiple times. And I think some people are thinking, listen, rates are going to fall, things are going to rebound. Like that has been the narrative for quite some time. So some investors are holding out for that, potentially for that outcome, and thinking, if I don't sell, if I don't get my price now, I'm just going to take it off the market and rent it. And we talked about this on the show like 2-3 months ago, like people actually deciding to do that, thinking in a year or 2 years, they're going to make a lot more money. So again, it's tough to say how it all plays out, but definitely if inventory continues to build, we'll probably see more people pulling the plug and just, you know, throwing in the towel and taking a little bit of a loss. But we haven't seen that to any significant extent yet. Yeah, prices are coming off a little bit here and there, but not anything material, I'd say.
It's kind
Steve,
of like,
sorry, go ahead.
It's kind of like a loss aversion. Like I think Nassim Taleb talks about it quite a bit, right? Which is like that psychological. It's like, you know, at one point at the peak of the market, your condo was worth 800,000. You know, now your realtor's telling you to list it for 750, and you're getting bids at 700, and you're just like, you know what I mean? Like it's like, well, it was 800, and so like the psychological impact of knowing, like, I just think it's so, you know, it's so sticky on the way down because people just kind of kick and scream and say, well, what could have been? I should have cashed out at the highs. Maybe it will come back. You know, I'm leaving $100,000 on the table. And so, you know, I think it's almost like that slow bleed, like where John, like, you know, maybe this condo is 700 today, and maybe 18 months from now, it's still 700.
Yeah.
And then it's like, then, you know, I think sellers finally, like, reality sets in. They go, well, how long am I going to wait? Am I going to wait another 3 more years? Like at some point you just kind of cut your losses, or not your losses, but you sort of just, you come to your senses in reality, and you move. And I remember seeing this in 2016 into 2018. So I remember there was like, I'll give you an example, for like the detached housing market in large parts of Vancouver peaked in like February, March of 2016 with like the huge wave of foreign buyers. And then it peaked and then it rolled over. But all the people that started listing in April, May of 2016 kept listing at the February 2016 price. And they basically just sat there and they would take it off. They would relist. And they were trying that. And they would literally, like, a lot of these houses sat in the market for like 2 years. And they eventually sold like on the lows in 2018. They eventually sold on the, like, took them 2 years. And it's like, Matt, like, if you taken the price in, you know, May of 2016, you would have been way better off. But people waited 2 years and eventually sold even lower in 2018.
And I mean, this is in the literature. I think like even Daniel Kahneman wrote about this, where, you know, when prices are rising in the housing market, people, of course, look at their capital gain based on what they bought their home for, which obviously makes sense. But when prices have dipped a little bit, the anchor that they use to determine their gain or loss is actually the peak prices. Meaning, if I bought a condo for $500,000 and it went out to 800,000, but then it dropped to 7, the average person does not think of this as a $200,000 gain, which it is. They see it as a $100,000 loss, right? And they're anchoring against that peak and wish they had sold at the peak and kind of want to get that peak and will hold out to get that, basically. And this is kind of the psychology of the market.
Wow, more evidence that the human mind is an incredible beast. Interesting. So I guess this Urmi needs a deal corner. We'll have to keep coming back to it for a bit to see if any of that dynamic changes. Both of you talked about interest rates probably coming down even more, but that would be because macroeconomic conditions are worsening. Out of the US, a really surprising jobs unemployment number saw a lot of shock actually in the market. The stock market also responding poorly. And so now the US picture, which seemed to have been bucking this hard landing trend, seems to have shifted. And if there are more rate cuts to come, it's against that backdrop. So Steve, yes, on the one hand, buyers will be seeing rate cuts. On the other hand, they're seeing more on instability financially. Also, the geopolitical news out of the Middle East, again, is even worse day by day. So how do you factor in those two different trends when you're a consumer? Like what tends to affect us more?
Yeah, I mean, I definitely feel like housing is like is a confidence game. Like, you know, if people feel confident about their job prospects and their wealth, I mean, people transact. So I think it can give people more hesitation, right? If like, hey, recession's here, is my job safe? Like, I think that can definitely play a factor for people making decisions. I would also add, though, I mean, this is maybe a bit controversial. I don't know if this is controversial. I think it's people get upset when you say this, but this is just the reality. When I look at markets like Vancouver, where we know price to income ratios are egregious because these aren't housing markets that transact off of incomes a lot of the times. You know, if someone that's buying a $2.5 million in Vancouver, I mean, they're pretty wealthy. They've got large sums of wealth they've accumulated or been passed down to. This is not someone that's working a blue collar job and is buying a $2.5 million house. Like, so, and I say that saying that, like, what are the jobs that we lose in a recession typically in like a modest recession? It can impact people maybe on the lower scales. And so this tends to impact maybe more of the rental market. Maybe it's more of the outskirts suburban markets. I just find that, like, and this is the same, I'm saying this because we have to look back at like what happened during the pandemic, right? Like we had what, 10% unemployment rate in the housing market was on fire. Because a lot of people that lost their jobs were like, it was maybe a lower skilled job, right? It was like your cashier at the local bakery shop. It was so like I think that's important to, and again, people are gonna hate that, but like I'm saying this because this is what I experience on a day-to-day basis. Like people that are buying in Vancouver, they're of a different, it's a different means. It's a wealth-based.
Yeah, it's interesting observation because their interest rates, hunting for the best return becomes more of the question. So that is an interesting observation. John, what do you think about in the GTA area where so many newcomers are here coming with professional jobs, but we're starting to see even in Canada, this strange paradox where, fine, maybe again, we avoided a bit of a hard landing, but job unemployment numbers for IT workers, newcomers, for young people are climbing. So, the GTA has been driven, to my mind, by two trends. Yes, there is this investment trend, but there's also this two couple pretty well high enough income service households. How would that shifting dynamic affect the GTA?
So, I mean, Steve's right. Even in the Toronto area, homes are largely bought by capital, not driven by income. I mean, you can borrow maybe 4.5 times your income, 5 times your income. House prices are nearly 10 times income. So obviously you need a ton of capital. One thing I'll say, and I don't know if I 100% agree with Steve, like on the unemployment situation, like I don't know, and I can't say I've studied this, I'm not convinced that the most vulnerable jobs are the lower paying ones. Like I would think that, if this kind of recession, and we're probably technically not in a recession in Canada, I mean, partly because our population's booming by 1.2 million people per year. which is adding to our GDP, right? And this is kind of this problem where technically we're not in a recession, but we're, if you look at GDP per capita, we really are, which is why people feel like we're a recession, even though the top line numbers are fine.
So to clarify, John, you're saying GDP, overall GDP is how recessions are calculated. Certain amount of contraction over a certain amount of quarters means you're technically in recession.
Yes.
Canada is not reaching that, but you're suggesting that our GDP per capita suggests that we are reaching that.
Well, we are. We're down like GDP per capita. So if you adjust it for our population, it's how many quarters have been negative?
8.
I don't know. It's 8? Yeah. So 2 years, right? We've had negative growth per capita. And again, when you're growing by 1.2 million people per year, that is boosting your top line numbers. Like that's just the math, right? But anyways, going back to kind of the unemployment question, I do think, listen, I think it's still early, right? Like I think we don't know. And yeah, if you get, white collar normal jobs, we started to see some layoffs in big companies. Yeah, that's going to shift sentiment. People are going to be reluctant to buy. I don't know if you're going to have like distressed sales. Like I don't know. We'll see how this all plays out. The banks and the governments have been very eager to kind of help people in these situations. So they did that during COVID. If that happens again, we may not see a ton of distress, but you'll see people on the margins, obviously, who can't afford their housing. But above all, it's gonna obviously shift the sentiment in the housing market. So we got to see how it all plays out. Again, I think investors, homeowners look at a big drop in interest rates as bullish, and we've talked about that, but it's not bullish. It's because the economy's tanking, right? So
I have 2 points on that. So obviously, recession, more job loss is certainly not going to be what drives the investor back into the market. So there's just more stagnation there. But I think the point that I was really trying to emphasize is that I think in a recession, I think that there's markets that are more impacted than others. And so I think what happens is like the inner city, like the depth like of the inner Toronto market, their inner Vancouver market is going to be more resilient than a suburban market 45 minutes out, hour and a half out, where like as you get further and further out, these are more like local based, income based markets that I think will fluctuate more based on what's happening with the labor market. That's my opinion. I think there's more resiliency in the inner city. Just because I think it's more wealth derived and it has a lot more depth to it. But I'm not saying it's not going to be impacted. I'm just saying that was the point I was trying to make.
All right.
And to rescue you both, normal jobs, low skilled jobs, I think what you're talking about is the idea that when jobs are location based, like Steve was pointing out, there is a bigger danger of you losing your job if a plant closes, if somebody doesn't expand. But what I do find very interesting about these latest job reports in Canada is that they're hitting the IT sector. This is not a sector that you would describe as either low skilled or even tied to a location. I do wonder about the impact with that when you couple it with the argument that our GDP per capita is, our newcomers are helping us out. If a lot of these newcomers are in those fields, unable to get work, all of a sudden that buffer of your population boost starts to go away. And now do we start to see, GDP actually fall and feel it? And once a recession hits, even if people in different sectors are the ones losing their job at first, eventually they have to stop spending, and that starts hitting more and more sectors down the line, right? So I think we throw around a lot of terms, normal job, white collar job, but I think your point is more that the nature of the job loss will dictate early signs when it comes to real estate. In real estate, you'll see it first, depending on the type of job loss. In a widespread recession, what happens? I would think that becomes more risky across the board. And what is the likelihood that we would see a widespread recession?
I mean, who knows? The experts are still promising a soft landing, so we'll see.
The experts or the politicians?
The politicians, you're right.
Okay.
That employment rate's up 100 basis points, right, from the lows, and so I mean that's pretty significant. And I mean, I think there's definitely more job losses coming in the construction space, John. I mean, I think that
Yeah, 100%.
as these housing units that are under construction complete, I think everybody is well aware of what's happening with housing starts, and what's happening in the new construction pre-sale market. It's dead. So it'll be interesting to see there. I think there's going to be some unfortunate pain in the construction space.
All right, so another thing to keep an eye on, we will keep looking in on these changing conditions, but fair to say this is a shift. The US numbers have kind of shifted our mood. I mean, this idea that we dodged a bullet now has become this month less of a feeling.
Yeah, I'd say so. I mean, I mean, when I left for my trip, I mean, everything was pretty bullish in the US, you know? And so it's remarkable how things can change. I mean, even on our show, like if you look back to June, the narrative at that time, both in the US, like the narrative in the US is like, they're not even going to cut this year. You know, in Canada, it was like maybe 2 cuts, but rates are going to be high for long. You know, now the sentiment's like the Fed's going to cut twice in September, you know? So it's remarkable how quickly things can change, which is why it's impossible to predict the path of the housing market, because you can't predict these. In 2 months, everything has kind of effectively turned on a dime economically, it feels like.
So that's why when we say you have to tune into us weekly and monthly for this segment, we're not just saying that. So we'll keep an eye on that. Steve, sorry, did you have something to add there?
No, not really. I think it's yeah, I don't know. I mean, lower rates, John, as we talked about, should increase sales volumes off of what has been hovering near 20-year lows. So I don't know if that's something to get overly excited about, but yeah, I think there's still a lot of issues that are sort of embedded in this housing market that need to get worked through the system.
All right, so plenty of content generation for us, I guess, if there is any silver lining. Let's now turn to a question that I saw being debated again on Twitter. John, you've written about the CMHC recently releasing some research shedding more light on how much of our housing stock is in the Airbnb or short-term rental space. So CMHC did an interesting work here. They excluded properties that are primary residences. So examples in which you might be renting out a basement as an Airbnb, or I don't know if that's allowed in all jurisdictions, but if you are, or you're renting your house when you're away, for example, for a couple months a year. Those properties are being excluded because those are your primary residences. But of the remaining Airbnb rentals, they are estimating that 100,000 homes in Canada are being used basically as short-term rental businesses.
Mhm.
And, this is interesting. Airbnb itself has often fought its negative image in many communities around the world by saying, hey, it's about you being able to unlock the cash in your property. We don't want to compete with hotels. This suggests different. There is a segment that is just using this as a short-term rental business. And interestingly enough, though, John, you were critical of the CMHC saying, well, there's nothing we can do about that. You had some other thoughts.
I mean, so to clarify, it was actually StatsCan report, not CMHC report. But yeah, I mean, CMHC's one of their leading economists came out and said, well, no big deal, 100,000 homes. And to clarify, like you said, these are not 100,000. It's over 300,000 Airbnbs, but 100 of those are properties that have the potential to be long-term residents. So it's not someone's current home that they're renting. It's just a home they bought to use full-time as an Airbnb or something along those lines. So, I mean, again, it's fascinating to me because, you think 100,000 homes that could be used as permanent rentals or permanent homes would be something that our federal housing regulator would advocate for. But they're not. They're basically saying no big deal. And in fact, the lead economist came out and said, we actually need more of this. We don't want to discourage it. We want them to buy more of our new housing stock to fill more supply. So a very odd, I think, a narrative. Most countries around the world kind of can see the negative side effects of basically people buying blocks of homes and using them as mini hotels. And now we have CMHC, our housing regulator, effectively playing a PR firm for Airbnb and advocating for us needing even more Airbnb in Canada. So I don't know. I think it's completely backwards and highly problematic.
So John's coming from a country, Greece, which has recently seen a lot of anti-Airbnb sentiment. Correct,
Mhm.
John? Have they been doing a lot against this kind of short term?
Yeah, so I mean, and to clarify, I mean, some regions they're more comfortable with, like some of the islands empty out in September, October. Like no one really lives in some of these islands. So, buying up homes there and using them as Airbnbs is less problematic. But some of the islands that are inhabited kind of 12 months out of the year, and one of the islands I was on, they actually said that the municipality is looking at kind of banning them effectively for that reason, because it's driving up renting for residents.
So
All right,
I
Steve,
gotta, yeah,
do you have the same
I have to
take?
push. Well, yeah, I have to push back a little bit. I'm not a proponent of people going out and buying a single family house and then renting the entire thing year round on Airbnb. I think that's kind of ridiculous. Like, you should get a commercial zoning license to operate as a hotel, right? So that's kind of my view. I don't have an issue with people, renting out their laneway house or their basement suite on Airbnb, or they have a vacation summer cottage on the lake that they use for 4 months of the year and they want to rent it out for the other 6.
100%.
I'm okay with that. I just would want to put things into context. So for Canada, they said 107,000 dwellings for potential long term. So even if you added those 107,000 back into the pool, keep in mind that every single year our annual housing completions are what, John? About 250,
Yeah.
225 to 250, call it 200, call it 250,000. So like this is like less than half of our annual completion. So I'm putting that into context to say, like, I don't think like Airbnb it's one of the top scapegoats, I think it detracts from how structurally bad our housing market is, that like even if you added all of those back into the long-term pool, it's still only 100,000 when we're completing 250 a year, and our federal government's promising us 500,000 completions a year.
Yeah, I mean, listen, no one's saying that this is the singular cause of our freaking housing crisis. Like, no one's that nice. And I completely agree with you. You want to lease out your home on Airbnb while you're away for 3 months, all the power to you. But at the end of the day, in a country with like 3 million units short in housing, 100,000 is more than what they've been able to achieve in terms of new housing completions over the past 5 years. Right? So I don't know, like, what is the rational argument for advocating for that? I'm not saying it's going to transform everything, but effectively what CMHC is saying, well, the 100,000, families that could otherwise be renting and have a full-time residence or a home, let them eat cake, because we'd rather see kind of the Airbnb investors kind of maximize their return. So listen,
to be fair, the comms language, John, with CMHC felt that doing something about this problem wouldn't make a dent in our housing problem.
Nothing's making a dent. None of their zoning reforms aren't making a dent. Everyone was saying if you upzone Toronto and allow 4 properties where there's currently 1, it's going to change everything. Has done nothing. So nothing is going to be the one transformative policy. Like, and if that is our argument, then we're not going to make any changes. So anyhow,
I got a couple thoughts on that. Is yeah, I don't disagree with you. It's funny, right? Because like, I mean, the BC government's rezoning everything, and the feds are coming out and saying housing accelerator fund. I have 2 things on that. I think one is like none of the zoning changes are going to trump what's happening on the economic side, which is rates are up, building costs are high, labor costs are high. The numbers simply don't make sense. You can upzone the entire country and no one's going to build today because the numbers just don't make sense. I think at some point when we get this flush of the system, which will happen, and we'll kind of restart a new cycle, I think that zoning then can help spur more development. But it's pretty hard to spur more development too. At the same time, as like, what we've seen here is like they end up loosening the zoning, but then they add in all these new fees, development charges and fees that make it's, you know, we've talked about, I've called it this housing decelerator because it's been this huge heist. Basically, these municipalities are changing their zoning policy, and then behind the curtain, they're raising all their fees and taxes. So the developments are no longer economically viable in an already challenging development market.
Mhm.
So I think it's basically just these cities and provinces are basically just stealing from the feds, and the feds are dumb enough to fall for it.
Yeah, and that and you're 100% correct. I mean, that's a huge issue. I mean, when you're raising development charges, and for those people who don't know what that is, I mean, it's effectively a tax on every new home. That's what a development charge is. So, you know, and you've got to think about basic tax policy. When you're increasing taxes on something, you're trying to discourage the consumption or the development of it. You're not encouraging it by increasing taxes. So it's completely backwards to say we want more housing, but let's just keep ramping up the taxes on new housing.
We had one in the city of Burnaby here. They're pushing through, what are they pushing through? Is 50, I think it was about $50,000 per condo unit. And it just at the increase, not of the dollar amount. The
Wow.
increase is increasing by $50,000 per condo unit in terms of their development charges. I mean, it's a significant chunk of money in an already really, really challenging development market. And so I look at all this, like, John, I agree with you. Like, Airbnb's banning that's not the silver bullet. Upzoning's not the silver bullet. Interest rates aren't, like, it's just a combination of just such a broken market that I don't really think it matters necessarily who's in power. I think people can make things a little bit better, but I think structurally unfortunately it is a pretty busted market.
It is. I mean, and listen, the challenge with some of these supply side ideas, I mean, if we think about development charges are used to pay for infrastructure for new housing. So it's easy to say, let's get rid of them. But the bigger challenge is, you know, in a short period of time, we're expecting our governments to fundamentally change how they fund and finance new infrastructure for housing,
Totally.
which isn't going to be done over the weekend. Like, and this is the challenge with some of these ideas, and why this idea that we're going to triple housing completions that people have been promising, including CMHC, for years, is just they're just fairy tales.
I'll add one more for you. So in North Vancouver, in the district of North Vancouver here, they're increasing the permitting fees for a brand new single family house by $85,000.
Oh my gosh.
$85,000 increase just for the permit.
Wow.
House. So, like, you know, it's funny because people look at these like houses that people are building in like Texas, and for like, you get this big brand new house for like $400,000, and like, well, how do you build that from, you know what I mean? It's like, yeah, no, I think, John, what we're seeing is basically politically is all these cities and municipalities basically are really desperate for tax revenues, and it's politically unpopular and unpalatable to pass those revenues on into property taxes, right? To ask everyone to, hey, we're going to jack your property taxes because we need the revenues. So what they do is they say, well, okay, we'll keep your property taxes relatively stable. What we're going to do is we're going to fund that through development fees, because it's easier to sell politically, right? It's like the general public doesn't really know what's happening. They don't know that the developers are getting eye gouged.
Yep.
And it's, well, hey, you know, the rich developer, I mean, he's worth hundreds of millions of dollars. He can afford it. So what ends up happening is you just get less housing built over time. So that, I mean, that's just what's happening.
100%.
I would like to see more research actually on how many of the local US counties fund their own roads and things. Like some of these places have private roads and private infrastructure, and that's a widespread thing. So I'm not always sure that all of these examples translate, but it's some really interesting points on both sides of the argument. I am going to wear the last round to John for bringing the fire meter right up there. There's some passion in there, Johnny. And I'm glad we're ending on this note because I'm addicted to the Olympics. John is wearing a little more red too. There's more red and white there. So we're going to give it to John, but really good points on both sides. Let's dig into this though. I'm a little bit suspicious on the arguments from both parties. Mayors don't have the cash to build the roads. Developers are, you know, I don't want to pay anything, you know, crunch the numbers. Let's get some more discussion going.
Passing it on to buyers. Developers aren't paying anything. Like, it's home buyers who are paying these taxes.
Ooh, some more shots after the
This is
round's
the thing,
ended.
John, like, when you you and I give all these like speeches, and you go on stage and you talk about housing affordability and like try to, how can we fix it? How can we improve it? What's happening? And like, the sad reality is like, it's not going to change.
Yeah.
I don't see it. I think it can improve modestly around the fringes. You know, the chart can come down a little bit and get a little bit more housing affordability. But I think over the next decade, like, it sounds like a cop-out just to say, sorry guys, listen, it's not going to actually get any better. It is what it is. And I think it's just because if you look at the system, it's just, yeah, it's so broken that there's so many competing interests.
Yeah. I mean, I could go on a tangent there, but you know what? Well,
I'm going to summarize John's view that maybe in a world where you can do very little, it is surprising that politically, even our own agencies and politicians won't do some of the moves that you think would make even a drop in the bucket, because they aren't making enough of it. And I think that's what you're arguing on the Airbnb. Is that fair? All right. Let's keep this going. This was a great episode. Please keep thank you again, first to all our viewers, whether you're listening to our podcast or our show on YouTube, please keep all your questions coming and the discussion coming. And if you disagree, you can find John on X Twitter at John Pasalis. Steve is at Steve Saretsky. The Move Smartly show is at Move Smartly. And you can also put your comments on our YouTube channel. And we read all of them, and we'll look forward to this continuing conversation. Thank you so much to both of you. I hope you keep enjoying the rest of this hot, melty August, and we will reconvene in September.
Sounds great.